Corporate Finance Lectures number 11. Cash flow estimations in capital budgeting. In these lectures, we're going to learn how to estimate future cash flow from the project, and we will use this cash flow for the calculations of net present value, internal rate of returns, and payback period. We will be learning from an example of project variation. Now let's begin. A proposed project is about an installation of an equipment in a factory. The cost of the equipment alone is $200,000. To make the machines work, there will be additional costs on shipping and installations of $240,000. The total cost of the machines will be equal to the sum of $200,000 plus $40,000, $240,000. When the business installs this equipment in a factory, after the installations of the machine, before starting the operations, the companies will have to invest in the short-term operating asset called operating working capitals. The companies will have to prepare for the raw materials and even spare part of the machine. There will be an increase in inventories of $25,000. When a company purchases raw materials from the suppliers, the company receives trade credit from the suppliers. The account payable will increase by $5,000. Both are short-term operating assets and short-term operating liabilities. We can net them out using $25,000 subtracted by $5,000. The net operating working capitals for the projects will be equal to $20,000. The management forecasts that this new machine will generate sales of 100,000 units per year. The selling price of the products will be $2 each. The expected revenues earned will be equal to $200,000 per year. Associated with an increase in sales, there will be production costs and some selling and general administrative expenses that vary with sales. These are called variable costs. It's expected to be equal to 60% of sales. The project is expected to have a life equal to 4 years. We will be running the machines for 4 years. Each year it will generate a revenues of $200,000. At the end of year 4, the machines will have the market value equal to $25,000. This is the salvage value at the end of the project. We will fully depreciate the machines over the life of 4 years. The depreciation system here is the modified accelerated cost recovery system. So this is a US depreciation schedule. We will explain this depreciation scheme in the next slide. The marginal tax rate for the companies will be equal to 40%. The cost of capital for the project, which is equivalent to the cost of capital of the firms, equal to 10%. So we pretty much assume that the risk profile of the project is equivalent to that of the company itself. Let's look at the modified accelerated cost recovery system. In this framework, the company will be able to depreciate the value of the assets more in early years. For example, our machine has the expected life of 4 years. We will use a 3 years modified accelerated cost recovery system. Under this approach, the company will be able to depreciate the value of the equipment approximately 80% of the total cost of the machine in the first 2 years. By doing this, the company will be able to have some tax saving during the first 2 years and will be able to earn more operating cash flows as a result. Comparing to a straight line depreciation of 4 years, the depreciation each year will be the same. It is equal to 1/4 or 25%. So we see that in the first 2 years, 25% will be less than 33%. 25% in year 2 will also be less than 44%. Under the straight line depreciation approach, the depreciation will be the same each year, 25%, 25%. But under the accelerated cost recovery system, the depreciation during the first 2 years will be a lot. In this example, almost 80% of the total value of the equipment cost. An approach that we're going to use to evaluate the projects, whether this project is a profitable investment or not, we will use the discounted cash flow approach. This approach is similar to what we apply when we value the stock, when we value the corporate bond, and also when we use it to value the corporations. Now let's take a look. To determine the value of this project, we need to calculate the associated cash flow for the projects. In the first step, we're gonna draw a project's timeline. In our investment proposal machines, we have the time horizons of 4 years. We expect to use the machine for 4 years. Each year, we have to calculate the associated cash flows from year 0 to year 4. It will be the cash flow associated with the project every year. To make it more practical, we divided the associated cash flow into 3 groups of cash flow. The first group of cash flow is the initial investment. This is the cash flow that occurs in time 0, which is the present time. The second group of cash flow represents annual operating cash flows. Once we start the operations, the company will make sales and be able to earn cash flow from the business operation. So the second group of cash flow represents operating cash flows each year. At the end of the project, which is year 4, there will be the third group of cash flow called terminal cash flows. This terminal cash flow calculates from the after-tax salvage value plus a recovery of an investment in the net operating working capital. The changes in the net operating working capital must be incorporated in the capital budgeting process because this represents in the short-term operating asset net of short-term operating liabilities. They are part of the business operation that we have to consider when we want to value the projects. To recap the relevant cash flow used in the calculations, the first group of cash flow represents an initial investment at time 0. The second group of cash flow represents annual operating cash flow each year from years 1 until the end of the project. The third group of cash flow suggests that when we finish the project or when we terminate the project, what will be the relevant cash flows? It's called the terminal cash flows. The terminal cash flow consisted of the after-tax salvage value plus a recovery of net operating working capital that we have invested in the beginning of the project. Let's calculate the initial investment at time 0 or free cash flow at time 0. Let's recall that at time 0, we will not have any operating cash flows coming into the business. What we only have is the initial investment or the initial cash outflow. The cost of the equipment consisted of equipment cost and the installation cost. So the capital expenditures or an investment in the fixed asset at time 0 will be equal to $240,000. This represents a cash outflow. Besides an investment in the fixed asset, we also investment in the short-term operating asset, such as raw materials and spare parts for the machine. So this will increase an investment in inventory equal to $25,000. When we purchase raw material from the supplier, we receive a trade credit equal to $5,000. The net investment in the operating working capital is equal to $20,000. That represents changes in the net operating working capital, which is an investment in short-term operating assets, net of short-term operating liabilities. The net investment in the short-term operating working capitals of $20,000 is also a cash outflow at time zero, so we will include this $20,000 as part of the initial cash outflow. The relevant cash flows at time zero will be equal to $260,000. This is the cash outflow at time zero. Now we have completed a calculation of initial investment at time zero. Next, we're going to look at the operating cash flow each year over the next 4 years. This is the second group of cash flow that we're going to calculate. Before we calculate sales and associated operating expenses, we will first calculate how much would be the depreciation of the assets each year over the next 4 years. We plan to use the machines for 4 years, and the machines will be fully depreciated. This is 100%. To be functional, the total cost of the machines will be equal to $240,000. That includes an installation cost. Under the modified accelerated cost recovery system, the percentage and amount of depreciation each year is not the same. We will follow this depreciation schedule. In year 1, the depreciation percentage is 34% of the total equipment cost of $240,000. That's equivalent to $79,000 of depreciation in first year. In the second year, the depreciation is about 45% of the total machines cost $240,000. So it is $108,000 of depreciation expense in the second year. We follow the same calculations for the third years and the fourth years. And we observe that this machine will be fully depreciated at the end of year 4. Notice that if we use a straight line depreciation and the machine is fully depreciated over 4 years, the depreciation each year will be the same, 25% depreciation, 25%, and another 25% each year. This is for a straight line depreciation approach. Now we're ready to calculate the operating cash flow each year. The machine is expected to run for 4 years. Sales of the product is expected to be $200,000 each year. So that's $100,000 unit multiplied by the selling price of $2 each year. The associated operating costs are variable costs, so these operating expenses move with sales. It is considered to be 60% of sales. Each year will be the same proportion, 60% of sales. The numbers that are different every year are depreciation expenses. Because we did not use a straight line depreciation, we use a modified accelerated cost recovery system. The depreciation expenses are according to what we have calculated. Note that this system allows the company to depreciate more in the early years. The company will pay less taxes during the first 2 years. This allows the company to retain small operating cash flow in the early years. This is where the term cost recovery comes from. The company will be able to retain more operating cash flow from the investment in the early years. Under this depreciation scheme, each year we follow the same patterns of calculations. After we subtract operating costs and depreciation expenses from revenues, we have the operating profit called earning before interest and tax, EBIT. In this case, we assume a marginal tax rate of 40%. We will then calculating net operating profit after tax. This is the first component in the calculations of free cash flow. Then we add back non-cash expense, which is depreciation. To obtain the operating cash flows, net operating profit after tax, add back depreciation. And we do this every year to obtain annual operating cash flows for the projects. For the third set of cash flow, it is called terminal cash flows. At the end of the project, the machines will have the market value equal to $25,000. This is the salvage value. We will think as if that after the end of the projects, we might be able to liquidate or sell this asset and earn $25,000. But what relevance in the valuation is the after-tax cash flow. So we will calculate the after-tax salvage value, which is equal to $15,000, given that the marginal tax rate is 40%. This $15,000 is equivalent to a reverse of capital expenditure. It will be cash inflow because we sell the asset, since capital expenditure represents an investment in the fixed asset. In this situation, we sell the machine and earn the after-tax cash flows equal to $15,000. So the numbers will be positive 15. The last term in the equation represents changes in net operating working capital. At the end of the projects, we assume that we will recover all the operating working capitals that we have invested in time zeros. This is equivalent to cash inflow of $20,000. To remind everyone what is this $20,000 come from, we go back to time zero. In the beginnings of the project, we purchased raw materials and some spare parts of the equipment, $25,000. We received trade credit from the supplier of $5,000. So the net investment at time zero in this short-term operating asset or operating working capital is equal to $20,000. If every year we have no additional investment in the raw materials and spare part, whatever used in the productions at the end of year 1 will be replaced by the same amount at year 2. So the changes in net operating working capitals from year 1 to year 2 will be equal to $0. This is the concept of working capital. The old raw material that will be put in the production process will be replaced by the new raw materials that we purchase. The amount of operating working capital that we use each year will be equal to $20,000. The changes from year 1, year 2, and year 3 will be equal to 0. No additional investment needed. But at the end of the projects, the last set of raw material are used in the production process. They're gone. These raw materials turn into the finished product, and the company sells this finished product and collect cash back from the customers. So we assume that all the investment in operating working capitals will be recovered at the end of the project. Everything is finished at the end of the project. This cash inflow of $20,000 is the last item in the free cash flow equation. The first set of cash flow at the end of the projects come from operating cash flow, which is net operating profit after tax or NOPAT. Add back non-cash expense, which is the depreciation. This is equal to $54.7 thousand. This is the operating cash flows at year 4. NOPAT plus depreciation. Then the second group in the components of free cash flow represent an investment in long-term asset and additional investment in short-term operating asset or operating working capitals. In these examples, we sell the machine, so $15,000 will enter as positive numbers. We also recover operating working capitals equal to $20,000. It will also enter the equation with positive number, which is cash inflow. We add $35,000 on top of the operating cash flows at the end of the project. The relevant cash flow in year 4 is equal to $89.7 thousand. In the last step of project valuation, we put all the relevant cash flow in the project's timeline, which is 4 years. Cash flow at year 0 represents initial investment, which is equal to $260,000. The free cash flows in year 1, year 2, and year 3 consisted of annual operating cash flows. Annual operating cash flow is the first group of cash flow in the free cash flow equations, or from the operating cash flows table. It is the cash flow from the bottom lines. Now for cash flow at the end of the projects, it consisted of operating cash flows from the operation plus additional investment or cash flow from selling the asset, which is the second component. This is $89.7 thousand. Then we can calculate net present value given the cost of capital is equal to 10%. We have negative NPV. We will reject this project. By calculating the internal rate of returns and modify internal rate of returns, we get a rate of returns that is less than the cost of capital of 10%. So we will reject the projects. Under the payback method, this project will return the cash flow back to the business after year 3. 3.3 years is around here. This is the payback period from this investment. That's pretty much the core contents of the lecture. To value the project, we have to estimate the cash flow. You will be given information of the investment project. Then you have to work it out from scratch, estimate the cash flow, put the relevant cash flows on the project's timeline, and then calculate net present value, IRR, MIRRs, and payback period to decide whether this is a profitable project or not. Finance is not an exact science, so we will learn the what-if analysis under different scenarios. In this example, we install our equipment in the factory. What if we do not carry on this investment proposal? The facility can be leased out to someone else, and this would represent the cash inflow of $25,000. Do we have to include this number in the analysis? The answer is yes. This $25,000 represents an opportunity cost. If we do not install the equipment in the factory can be leased out for $25,000. The relevant cash flow for this opportunity cost must be on the after-tax basis. We multiply $25,000 by 1 minus T, given the tax rate equal to 40%. The after-tax opportunity cost relevant to this investment decision is equal to $15,000. This can be incorporated in the beginning of the project because this is what we have to give up to invest in the project. A second situation is, what if we have the old equipment running? When we purchase the new equipment, the old equipment must be gone. We can assume that we will sell the old equipment. This kind of project is called a replacement project. The relevant cash flows in the calculation must be based on the marginal cost, marginal benefit concept. So for the marginal benefit, we calculate the incremental cash flows. What is the additional cash flow generated if we install the new equipment? Let's use a simple example. If we purchase the new machine, which has a better technology, and this machine can generate sales of $7 a year. However, if we don't purchase the new machine, we can use the old machine. And the old machine generates sales of $5 a year. The incremental cash flow that we have to use in the calculation have to be $7 subtracted by $5. By installing the new equipment or the new machine, the company will be able to earn more sales, $2 a year, and that $2 will enter into the calculations. This is corresponding to the concept of marginal benefit, additional cash flows earned from this investment decision. To calculate the relevant depreciation expense, we have to compare the depreciation of the old machine with the depreciation of the new machine. What would be the additional depreciation expenses resulting from installing the new equipment? And this is corresponding to the marginal cost concept. What is the additional cost involving with the investment decision? Come to another scenario. In practice, the lives of the projects are not the same. Some projects may have the life of 4 years, another may have the life of 7 years, and usually the business will have to consider more than one project at a time. Then what can we do if we have several projects to consider and they have different expected life? To simplify the analysis, we have two machines to consider. The first machine is from vendor A. The cost of the machine is $50,000. We can use this machine for 4 years, and these are the relevant net cash flow. We have an alternative. The second machine is from vendor B. This machine costs $50,000. The machine uses high technology and is obsolete real quick, so we expect to use the machine for only 2 years. The cost of capital for this investment decision is equal to 10%. Then we will decide which machine should we pick. Given the cost of capital of 10%, we can simply calculate net present value for each machine. And we see that the net present value of machines from vendor A is higher than the net present value of machine from vendor B. So machine A is the winner. However, under this mutually exclusive decision, machine A may not be the better choice. Let's look at the cash flow pattern for each investment alternatives. Machine A can be used for 4 years. It generates the cash flow for 4 years. However, machine B can generate the cash flow for only the first 2 years. So we are comparing 4 years project with 2-year projects. We are not comparing apples and apples. What can we do to reconcile this situation? We can assume that what if we can use machine B for another 2 years? Now we are comparing 4 years project with 4-year projects. This approach is called a replacement change approach. We boot up machine B to have a common life which is equivalent to the life of machine A, 4 years. For the first 2 years, machine B generates the cash flow according to the setup. Now at the end of year 2, we have to assume that we can reinvest machine B for another 2 years. The cash flows in year 2 represent cash inflow and cash outflow from investment in machine B for another 2 years. The net cash flow that will be used in the calculations of NPV is $50,000 negative at time 0, $34,000 cash inflows at time 1, and it will be negative $22,500 at year 2. This is cash outflow. The relevant cash flows in year 3 will be $34,000 and cash flows in year 4 will be $27,500. Now we can calculate net present value for machine B as if we use this machine for 4 years. We can compare this present value for machine B, $6,600, with the net present value of machine A, $5,400. The real winners of this mutually exclusive investment is machine B. Let's consider a limitation of this replacement chain approach. What if we can use machine A for 7 years and machine B has a life of 11 years? So to find a common life, we have to repeat machine A for 11th time, and we have to repeat machine B for another 7 times to have a common life of 77 years. So it is troublesome in terms of the calculation if the business have to consider more than 2 projects at a time. We have a solutions for this. We can use the equivalence annual annuity approach. Now let's look how we could apply the EAA approach. To get a foundations of the equivalence annual annuity approach, we refer back to the lectures on time value of money. The last section of the lectures talk about loans amortization. Given the amounts of loans of $1,000 and the financing cost of 10%, we want to pay back the loans in 3 equal payments. In this setup, we can use the present value of annuity formulas in the calculations. That's the PVA formulas. The amount of loan is PV, present value, which is equal to $1,000. The financing cost of the loans is 10%. That's I. We expect to pay back the loan in 3 years. So N is equal to 3. The future value of the loans is equal to $0. We pay off all the loans. We calculate PMT, which is the annual payment. They are equal every year for the next 3 years. We can use this present value of annuity formulas and apply it in the different financial application. The life of the project is equal to N. The cost of capital for the project is I. This is the financing cost of the project. The present value of the project is the project NPV. So we enter project NPV as present value because NPV is calculated from all the future cash flow discounted into present time. So it's equivalent to PV in this equation. The FV will be set equal to 0 for the project's valuation because all the cash flow has been moved into present time, no more future value at the end of the project. We calculate PMT from this equation, and that represents the equivalent annual annuities. Now back to the equivalence annual annuity approach, EAA. For machines A, we expect to use machines A for 4 years. The cost of capital for machines A is 10%. Machine A has the net present value, which is the present value of all future cash flows. This is the net present value of machines A, $5.4 thousand. We solve for PMT, which is equal to $1.7 thousand. We can think of EAA as the NPV per year for machine A. We repeat the same for the second machine. Machine B has the life of 2 years. The cost of capital of 10%. The net present value of machine B is $3.6 thousand. The net present value of machine B, $3.6 thousand. We use this number in the calculations of EAA. We solve the present value of annuity equation, get the EAA equal to $2,000. Let's look at a final decision. Machine A has the net present value equal to $5.4 thousand. Machine B has the net present value equal to $3.6 thousand. However, we can use machines A for 4 years, but we can use machines B for only 2 years. Then we calculate EAA. EAA is pretty much the net present value per year. For 4 years operations of machines A, the net present value per year is $1.7 thousand. For machine B, the overall project net present value is $3.6 thousand, but we use machine B for only 2 years. So the net present value per year for machine B is $2,000. Now we compare the EAA or net present value per year from each machine, and we see that machine B is the winner. Next is a situation on inflation. To adjust for inflation rate, we must adjust the cash flow of the projects. An example is What if we expect the inflation rate to be equal to 5% per year? What will be the inflation adjustment in the project's valuation? Remember that the discount rate that we use is the nominal cost of capitals. The nominal rate already incorporates inflation rate. What we need to adjust or build inflation into is the forecasted cash flows from the project. We do this by revising the calculations of operating cash flow each year. We expect the inflation rate to be 5% each year. Our adjustment will start from the first item. The revenues will be increased by 5% each year. The total production volume can be hold fixed. The selling price of the products will be adjusted upward 5% each year. Since operating costs vary with sales, it assumed to be 60% of sales. The numbers increases every year to accommodate for inflation rate of 5%. The price of raw materials also increased. Depreciation is hold fixed across 4 years according to the calculations from the depreciation schedules. Then we follow the same calculation patterns, get operating profit or EBAT. After subtracting tax, we get net operating profit after tax. Then we add back non-cash expense, which is depreciation. Now we have operating cash flow each year that include inflation adjustment. The last step is to put the associated cash flow into the project's timeline. These are the cash flows that will be used for the calculations of NPVs and IRR. This investment project is profitable since NPV is greater than 0 and internal rate of returns is higher than the cost of capital. The last part is to do a scenario analysis. In our sales forecast, we expect to produce and sell 100,000 units. This is our base case scenario. The situations might be worse and we might be able to sell only 75,000 units. If things turn out to be very good, we might be able to sell 125,000 units. These are forecasted numbers based on 3 scenarios: worst case analysis, base case analysis, and the best case analysis. The worst case has the associated probabilities of 25%. The best case also has the associated probabilities of 25%. Under a normal situation or the base case, associated probability is 50%. And these are the corresponding sale units that are forecasted from our production managers. Given the unit sale, we repeat the calculations of relevant cash flows. Then we can calculate net present value under each scenario. And we see that under each scenario there are associated probabilities. We can find the expected value that use probabilities multiplied by net present value under each scenario. The expected value, which is the expected net present value in this application, is equal to $15,000. Given the mean of 15, we can calculate deviations from the mean. This is the calculation of standard deviation. We get standard deviations equal to 30. To normalize the number, we can calculate coefficients of variation, which is risk divided by return, or standard deviation divided by expected value. The risk per 1 unit of returns is equal to 2. Risk is twice the return. So this project is classified as a high-risk project. In this lecture, we only look at the project risk or standalone risk. If we look at the portfolio of investment project for the companies, then we have to consider corporate risk. The market risk is when we consider risk from the overall economies or the overall industry. And that's it for the lecture. Please practice the exercise. In this exercise, you have to calculate net present value for the 3 years project. To make it simple for you to practice, the depreciation scheme is straight line. And don't forget, at the end of the project, we will recover the investment in the operating working capitals. You have information on the cost of capital, which is 10%. The investment cost for the machine is $70,000. By carry on this investment proposal, you need the investment in short-term operating asset or operating working capitals of $10,000. A straight line depreciation is 33.3% each year. It is 1/3. Expected revenue and costs are as follows. At the end of the project, the salvage value of the machine is $5,000. We assume a marginal tax rate of 35%. Good luck on your study and practice the exercise. Thank you.